It's been weeks of intense data crunching and we're just about ready to release the 8th analyst survey. The analysts cover all major sectors and all regions globally. In fact, they have more than 16,000 company meetings a year, so it gives us a really good granular picture of what's going on the ground.
Hello.
Hi Cameron. It's a proper team effort between all my colleagues in editorial, in Hong Kong and in London, and of course all the analysts and particularly the heads of research.
Hi Michael and Marty.
Hi.
Thank you very much for coming.
Pleasure.
Thank you.
Really good to see you.
Maybe what stands out the most is just the general level of confidence overall, and just looking at the global sentiment indicator that we create, it's the strongest in 5 years. Had you expected that?
To a degree. I mean, we saw the initial indications of recovery coming in the 2017 survey. I think what's also interesting for me is just how broadly based that recovery is. So looking across the regions, every region showing an improvement. Looking across sectors, almost every sector is also showing an improvement.
I think the thing that really jumped out at me was the confidence in management.
I mean, we all know we're in a very late stage of the economic cycle, of the market cycle, pretty much globally. Wouldn't you have expected, given that this is a forward-looking indicator, for things to start rolling over maybe a little bit by this time?
A little bit, but I think what comes through on the survey is that we are not seeing any sort of recessionary signs. They're not seeing any inflationary build-up. You see dividend growth outlook very strong, underpinned by strong balance sheets, yes, but also by improving returns on capital, which itself is very much demand-led. Rather than cost-led, which has been a feature of previous years.
Michael, last year you pointed out that CapEx seemed to be troughing and that was really significant. What do you think this year with these numbers?
It plays to the theme that we were discussing about management confidence. Confident managers will be investing more in their business. Then we look at the composition of this, it's much more growth-driven rather than purely maintenance CapEx.
What's profound about the CapEx, the sentiment increase in CapEx year over year is that it's across all regions and all sectors, really. Most profound are in the more commodities-based sectors. So if you look at energy and materials, a sharp increase in expectations for CapEx. Not unsurprising given the change in oil price year over year.
The two regions that really stood out in capital spending plans were China and the US. In the US, it's got to do with capacity constraints, for example, logistics and tax reforms. In China, it's a combination of factors. It's supply side reforms, it's the clamp down on pollution, and it's the fact that companies have cleaned up their balance sheets over the last 18 months and their cash flows, and they are in a better position now to invest. How about inflationary pressures?
I think the good news from the analyst survey is that the output is quite balanced. We're looking at what expectations do we think companies will have as far as their ability to raise costs. That's pretty much coming out in line with CPI across all the regions that we're looking at.
Yeah.
I think you have to look at that in the context of operating margins being close to all-time highs across many sectors. So against that backdrop, it's perhaps unsurprising that analysts are expecting companies to absorb some of these cost pressures within margin rather than necessarily being able to pass it on in the form of above inflation price increases.
And if margins are so healthy, as you say, Marty, is that one of the factors behind few concerns around leverage and defaults, etc.?
It definitely has played into stronger free cash flow and the ability for companies to manage their balance sheets pretty carefully. The other factor that plays into that is the low interest rate environment that we've had, which has allowed companies to refinance and push out their maturity calendars. So their need to tap credit markets to refinance maturities in the near term is greatly diminished from where it was a couple of years ago.
There is a lot of concern in the market right now about the rising interest rate environment. However, given the fact that most companies, particularly in the consumer staples sector that I cover, have lots of long-dated bonds, it's actually not going to have any impact in the near term unless a company wants to do something like engage in large-scale M&A that they'd have to finance, or if a company might be taken private by private equity. These are the only real situations in which I'd say that financing costs are going to materially increase.
We've had a couple of political questions over the last few years, given sort of the global environment. Anything of concern to either of you?
I think the striking thing is that geopolitics isn't viewed as a major negative almost anywhere in the world.
How about US politics? How about repatriated cash? That's one thing that did come through in a new question that we asked. What are companies doing with that?
What's coming through clear to me is that the cash is going to be largely used for enhanced shareholder returns in the form of share buybacks or dividend, and yes, also some additional employment.
And that feeds right into our the question around balance sheet strength, because that repatriated cash, even if it's mostly going towards shareholder returns, it does mean the companies need to borrow that much less to fund maturities or to fund dividends, which they've been doing a little bit in the past.
What's really exciting for us, because we're often asked about it, is the growing focus on ESG, which comes through in this year's data. And we see it across the world. It's no longer just a preserve of European countries.
It's clear that environmental protection is one of China's most important and urgent national priorities. This is driven by President Xi himself. And in the 19th Party Congress last year, he made it clear that China was shifting from a model of focusing only on absolute GDP growth to looking at sustainable development objectives. So if you like, moving from focusing on quantity of growth to looking at quality of growth. This, we think, is driving a broader shift in China's industries, moving from lower-end polluting industries towards high-end value-added businesses.
It's also, I think, when you drill down into the data, you see really change in emphasis. Some of the older economies, sectors really looking to emphasize the environmental aspect of ESG, and some of the newer tech-related sectors looking to emphasize more cybersecurity and data protection.
Why is that, you think? Is it the pressure from shareholders? Is it pressure from media? Where is this coming from?
I think management teams are realizing that the younger generation, this is what they're looking for, not just from an investment perspective, but also from a consumer perspective. People want to buy products from companies that are doing the right thing for environment and social issues.
That's great. Thanks, Michael. Thanks, Marty.